and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, the Conférence de Paris, which brings together leaders from business, share their knowledge on ways to overcome the biggest global challenges. And here are our top stories. A top Russian general is killed in a bomb explosion in Moscow. A source tells Bloomberg Ukraine was responsible. China reportedly plans to set an annual growth goal of about 5% for next year and raise the budget deficit to 4% of GDP, days after top leaders wrap up a yearly economic conference. Plus, we talk to Mike Henry, the chief executive of mining giant BHP, on the energy transition and booming demand for copper. Now, also on the program, a big focus, of course, on the economic impact of the political turmoil in France and Germany. Very shortly, we'll be speaking to the president of Germany's IFO Institute, and then later we'll be joined exclusively here in Paris by Maurice Levy, the chairman emeritus of Publicis Groupe. Now, first thing is first, let's take a look at the European markets map. Now, we're inching closer to, of course, the big thing that I've been waiting for the last 8 weeks, and that is the Federal Reserve decision. Now, stocks were trading across most regions. Again, traders await the Federal Reserve final interest rate decision for 2024 and its monetary policy forecast. A couple of things we need to watch out for. U.S. stocks on course to outperform their global peers by a wide margin this year. Now, this goes back to the idea of American exceptionalism, and there's also quite a lot of optimism about the impact of artificial intelligence. So let's go straight to cross assets. We're looking for the Fed Chair Jay Powell, of course, widely expected to announce a further 25 basis point of easing on Wednesday. The path of the following months, frankly, is less clear, and that's because of the Trump trade and also the fact that we have Inauguration Day, January 20th. Now, the other news we're watching out for is Germany. So we have the IFO Institute coming out shortly, but Germany is also going to cut the federal debt sales by 13% to about 380 billion euros. Remember, deficit but also asset sales is one of the big things that we're watching out for here on Bloomberg TV to try and look forward to what it means for budget deficits. But also remember, the big question mark in the market is whether there could be an ugly auction, be it in the UK, Germany, or even the U.S. Now, that IFO Institute for December, business confidence coming in pretty much as expected, maybe a touch lower, 84.7. The estimate was 85.5. So to talk about the German economy, we're now joined by Clemens Fuest. He's president at the IFO Institute. Mr. Fuest, thank you for joining us. There are many, many concerns about Germany going forward. Is it now the sick man of Europe?
It looks like it. It's this weakness in the German economy is becoming chronic. The German economy is not in a slump, so it's not going down very quickly. It's not a classical crisis, but it's stagnating. It's been stagnating for a long time, and that's what we see. What we see again in the data. And the focus of this stagnation is really manufacturing, where things are just not getting better.
So, Mr. First of all, is there anything structural that Germany can address after the next elections?
This is clearly a structural crisis, and it has to do with the manufacturing sector in particular. There are two areas of concern: the automotive industry struggling with the transition towards electric mobility and increasing relevance of IT. And then there is the energy-intensive sector, the chemical industry, the metal industry, suffering from high energy prices and a lot of uncertainty about the future of energy supply in Germany. Germany is pursuing a very narrow energy policy, focusing entirely on renewables, and that does create a lot of uncertainty. So it's these structural issues. And then, of course, this broader question, how will Germany cope with demographic change, declining workforce? We already see this in the structure of the economy and the labor market, with health and care expanding and manufacturing declining.
How much do you worry about the labor market? So there's a concern that then Germany is on the brink of big layoffs, and that this could come soon quite quickly, leading to a kind of spiral.
There are concerns about employment in manufacturing. That has been declining for some time, and now increasingly large companies are announcing layoff. At the same time, the labor market is stabilized. by the public sector, because we've seen a public sector build up for a long time, that the public sector is expanding. And here it is the health sector and the care sector where more and more people are employed as a result of an aging population that needs more healthcare. So the overall labor market is stabilized by the fact that demographic change reduces the size of the workforce. The trouble is wages are stagnating or declining because the structural change towards the service industry is associated with lower productivity.
What can you tell us about what you would put as priority in the snap election? So what can the next government do to make things a little bit better? What would you do as priorities if you were in charge?
I think the next government needs to prioritize economic growth, and within that, it needs to prioritize labor supply, investment, and innovation, these three areas. So create better conditions for labor supply. We see work hours declining in Germany, and that's because of problems in the tax and transfer system, because of a lack of childcare. We see investors fleeing because Germany has the highest corporate tax rate in the G7. It has too much bureaucratic burden. It has problematic regulations. The government needs to address that. And then we need to revitalize innovation, do more for the creation of new companies, because automotive and energy-intensive industries are declining. We urgently need new ideas and new companies. And there are opportunities. There are new companies, but they face difficulties growing due to a lack of capital for new companies. So we need to change these things. And if we do that, Germany can grow again.
How important, Mr. Fuest, how important is it to get rid of, the debt brake or to change it? We know that this current chancellor was saying, look, we need to do something to spend in terms of infrastructure and defense. So will growth only come with extra government spending first?
I think the debt brake is, in a way, a scapegoat, but not the cause of our difficulties. The public sector deficit is 2%, so there are many ways of getting around the debt brake, and that has been utilized. It's not like the government is not running deficits. I think what we need to do first is come up with a meaningful growth agenda, and then we can discuss how we finance it. There are enough possibilities to get into financing through public companies, so the debt brake isn't really our problem.
The Bundesbank, I think, says that because of the Trump tariffs, economic output will be hit between 1.3 and 1.4%. Does that seem reasonable in terms of estimates to you?
I think it's maybe a bit early to say that, because whether Trump will really come up with these tariffs is unclear. And we maybe tend to forget that Trump also wants to increase the deficit in the U.S., get rid of bureaucracy, cut taxes, and that may increase imports to the U.S. And compensate for the tariffs, maybe. So I think what Trump does create is a lot of uncertainty, but how that will play out is unclear.
Mm-hmm. Clemens Fuest, thank you so much for joining us. That was the president at the IFO Institute. Now let's get on to China. And Chinese leaders plan to raise the budget deficit to 4% of GDP and set an annual growth goal of about 5% next year. That's according to a report today. Now, for more, let's get straight to Bloomberg's James Mager in Beijing. James, thank you for joining us. So what do you make of the China reportedly planning to raise its deficit to the highest on record?
I think what's important is that you're seeing the growth target has been kept about the same, so about 5%. But the government is saying they're going to have to spend a lot more money to achieve that. I don't think the 4% number is really what's material here. There's a lot of stuff that's left out of that number, a lot of bond sales and a lot of other spending that's not actually included in that sort of headline deficit. And if you include all that, it's probably closer to 8 to 10%. But what we're seeing, what these numbers are showing, is kind of confirming what we saw in the Central Economic Work Conference last week, that the government is saying they still want the economy to grow, they want people to spend more, but really the central government in Beijing is going to have to step up and spend a lot more to achieve that 5% target. They're on track for this year, at least in the headline number, and they're saying they want to achieve that again. But Beijing is saying they're going to spend a lot more money to do that.
James, thanks so much. James Mager there in Beijing. Now, coming up, we'll have plenty more, of course, on our top stories. Also, a top Russian general was killed in a bomb explosion in Moscow in what appears to be a rare assassination of a top military official in the country. So we'll have the details next. And this is Bloomberg. Well, Ukraine has claimed responsibility for the assassination of the head of Russia's radiological, chemical and biological defense troops in a bomb explosion in Moscow. Now, that's according to a person familiar with the matter. For more on all of this, let's get straight to Ross Matheson, our EMEA news director. Ross, I mean, this feels like a very big deal. It's also a new strategy by Ukraine to target these generals inside Russia. What's the way forward?
Well, it's interesting to see this development inside the heart of Russia, because what we've really seen so far from Ukraine, obviously, is stepped up attacks inside Russian soil, but mostly confined to those border areas between Russia and Ukraine in the far reaches of Russia. We've seen drone attacks, obviously, on Moscow itself, but the targeting of a senior Russian military figure, the Lieutenant General, as you're saying, of the biological and chemical weapons defense forces inside Russia, as the source is telling us, happened, is perhaps a new development, because it really does bring this war again to the heart of Moscow. You can see these attacks on the border areas. You know, they're obviously an embarrassment to some extent for Vladimir Putin, the Russian president, but they're a bit easy to dismiss if you're inside Moscow itself, because it's a very long way away. If you have these very visible attacks occurring inside Moscow, it's a bit harder to dismiss or to brush off. And is this the start of more of what we call a decapitation strategy, which is coming directly for senior figures in the Russian leadership, the Russian military leadership inside Russia itself?
Ross, how big of a blow is it for Vladimir Putin?
Well, it is embarrassing for him. I mean, this Lieutenant General commanded these forces, and only yesterday, I believe, Ukraine charged him in absentia for what it says was the use of chemical weapons inside Ukraine in this conflict. He's not essential to Russia's war machinery. This will not change the trajectory of the war inside Ukraine, or the sense we're heading towards a point, especially with the US changing the administration into Donald Trump, that we're coming towards a negotiation. But it is visibly embarrassing for Vladimir Putin, who is all about the veneer of showing he's totally in control at home. And we've had a series of these things. Of course, we also had that attack at a concert venue earlier this year where more than 100 people were killed, and that was claimed by Islamic State. So the fact that these actors, be it Ukraine, be it other entities, be it Islamic State, can reach into Moscow and do this very visibly is obviously embarrassing for Vladimir Putin.
Ross, thanks so much. Ross Matheson there, Bloomberg's EMEA news director. Now, coming up, we're, of course, here live from the Conférence de Paris. We'll be speaking exclusively to Maurice Levy, the chairman emeritus at Publicis, about France's political crisis and the impact on the economy. That's next, and this is Bloomberg. Well, French lawmakers unanimously adopted a stopgap budget bill intended to enable the state to keep functioning from January. This, of course, comes as the country's central bank also cut its domestic growth outlook, citing the political upheaval. Now, let's discuss the impact of France's political crisis with Maurice Levy, chairman emeritus of Publicis, who joins me exclusively at the Conférence de Paris. Monsieur Levy, thank you for joining us. I mean, you understand French politics more than anyone in business. You've, for many years, of course, advised all the most important chief executives in the world and France. What do they need now from the new government?
They need some very clear decision and a little bit of vision. What happened recently with the departure of Michel Garnier is a shame, because he was really taking the right direction. And we do hope that the new government of François Bayrou will last a little bit longer, and that he will be in a position to make some strong decision. What we do need is a clear direction. Emmanuel Macron has been able to make France more attractive to foreign investment with not only Choose France, but a lot of decision around Choose France. And we may have some difficulties if we don't give some very strong signals to the international community of investors.
This seems near impossible if you have a parliament that's split three ways and you have a prime minister that kind of has to cobble together a budget. What would you put in the budget to give chief executives the assurance that they need? Is it deregulation? Is it growth plan? Is it something else?
As you said, it will be almost impossible to get a common platform. Almost impossible, because there is the far left, the far right, and there is the center who has no majority. So no one can have the majority without making an agreement with one of the extreme parties. Therefore, we can't expect to have strong decision made. We can't expect to have some strong cuts. And I'm afraid that what we will see, more than what we would love to see, is a raise on taxes. This is very unfortunate, because the last thing that France needs is to raise taxes. And as it will be almost impossible to find a common platform for the three large groups, I believe that we will be in a stalemate for a short while. When I say a short while, I'm afraid until the end of the mandate of Emmanuel Macron.
So you've been in the advertising industry forever. I mean, there's now a mega merger, Omnicom buying IPG for a huge vast of money. Does it make sense for advertising to consolidate even further? Is bigger always better?
For the people who are a little bit old, like myself, this is déjà vu, because there was a Publicis Omnicom Group merger which has been agreed upon in 2013 and has not been able to get done for a lot of reasons. I think it was a great idea at that time, because scale was of the utmost importance. Today, with the development of AI, with the development of a lot of technology tools, this makes less sense. But I believe that these kind of behemoths may have some negative impact in terms of employment. We will see a lot of layoffs. They have forecasted to have $750 million US dollars in synergies. If that pass, and if the authorization are given and all of the hurdles are passed, I believe that it will be a formidable competitor. And that is something which is exciting us a lot.
I mean, the other exciting thing, or the biggest thing to navigate for a French or European CEO, is the arrival of Donald Trump and what that means for tariffs in practically every industry. You've met Donald Trump in Davos many years ago. I mean, what's the right strategy in trying to either Trump-proof an economy or actually do something so that the company doesn't get hit?
He wrote a book about deal making. He is a deal maker. And we have to find the right deal with him. We have to find the way to give and take. I give you that, I take this. And if we are not coming with something positive and trying to find the right balance, we know what he's expecting. He's expecting to make America great again. This means more employment. This means more jobs. This means also less imbalance in trade balance. And this will be tough for China, and it will be difficult for EU. We need to have a more coherent EU, which will be a bit difficult because you have the collapse of the government in Germany yesterday. You have the difficulties of the current government in France. And you have at least 3 or 4 different ways of thinking in Europe. So therefore, without the tandem, the couple, the German and French couple, it's very difficult to get Europe moving. So I hope that we'll find ways, but I'm not very optimistic.
Okay, Maurice, Levy, thank you so much. You'll have to come back on to talk to us about strategy and why you're not so optimistic going forward. The Chairman Emeritus of Publicis Groupe. Coming up, we'll have plenty more, of course, from the Conférence de Paris. We'll look ahead to a lot of central bank decisions coming this week, starting with the Fed tomorrow. And then we also speak exclusively to the Chief Executive Officer of BHP, Mike Henry. That's shortly, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris, and these are your top stories. We start in Russia. A top Russian general is killed in a bomb explosion in Moscow. A source tells Bloomberg Ukraine was responsible. China reportedly plans to set an annual growth goal of about 5% for the next year and raise a budget deficit to 4% of GDP days after top leaders wrap up a yearly economic conference. Plus, we talked to Mike Henry, the chief executive of mining giant BHP, on the energy transition and booming demand for copper. But first thing is first, traders, of course, gearing up for interest rates decisions from several of the world's most important central banks over the next few days. Now, the Fed widely expected to deliver a quarter-point rate cut tomorrow. Joining us now is Ursula Marchioni, BlackRock's managing director and head of EMEA investment at Portfolio Solutions. Ursula, as always, thank you so much for coming on. I'm sorry I'm in Paris and you're in London today, but all eyes on the Fed. The concern is what happens after the rate cut. How much visibility do you have on the path forward?
Good morning, Francine. Thank you for having me. So yes, I think a theme in terms of forward-looking paths for central banks, and to your point, there's so much in Santa's bag for us this week, is a theme of divergence. So if we look at the ECB action last week and then going into 2025, 5 cuts expected towards a terminal rate for the year between 1.5 and 2. Then move to the Fed tomorrow, to your point, expected cut, and then moving into 2025, 3 more being priced in now towards a terminal rate between 3.5 and 3.75. So again, you can see the difference across the 2 paths becoming more extreme and then translating into investors' behaviours and choices.
Ursula, how difficult will it be for the Fed to set a rate path given all of the unknowns with the Trump presidency, trade, tariffs, and the art of the deal that we're not sure what it looks like?
Yeah, it's a very good question, and it goes back to the new regime we all invest in now, having greater uncertainty. But taking a step back, if I look into tomorrow, I feel it's reasonable to expect Chair Powell to have a more hawkish tone, pointing towards more solid growth of the economy, a stabilisation of the labour market. And on the inflation front, I very much see a first leg of inflation reduction having completed relatively smoothly. The next leg will probably be more complex to achieve. And so for the Fed, buying optionalities and actually being cautious around both the uncertainty that you point towards in terms of policies, but also, the broader set of data that we'll continue to see is important. Now, going back to that divergence, Francine, what I find really interesting is that, it doesn't quite seem to change in any material form the big theme that we all continue to debate, discuss, some hate, US exceptionalism. And so if I look at November data, if I look at month-to-date data, that continues to come through. And so we have this element around central bank paths and markets continuing on a very set front.
But Ursula, and I understand, and of course everything you go through is through the ETF lens, but it's really quite incredible when you look at equities. It's all about U.S. exceptionalism, but then a lot of these equities are priced to perfection. So is there a turning point in 2025, and where do investors deploy cash then?
Yes, that is the key question. And I think you're right in terms of the horizon that we're looking at for the trade is the key determinant here. So tactical versus more strategic, short-term versus longer-term. If I look at where investors are moving their money, again, November, we saw $205 billion flowing into the ETP industry. Of that, 73% went into U.S. equities. So, not just in equities, in U.S. equities, through large cap, but also small cap, mid cap financials. So, big cyclical vote of confidence. And December month today is very much a continuation of that. So, in the immediate term, Francine, I think it's difficult to see a big exogenous factor that unsettles that path. Going forward, that is where the discussion becomes interesting, particularly for investors, for our clients in Europe, where home biases towards our region are part of the benchmark. And so, again, European exposure is important. Right. And so looking at this year, there's loads of interesting points. Look at the IBEX, the DAX performance versus the S&P 500 equal weighted actually being better. Look at certain sectors such as luxury. So, again, there's a lot there to be said in terms of opportunities to differentiate and select through active investment. To your point, ETP flows are only a part of the industry. They're useful to give a sense of where the market is going, but there's a broader opportunity set that I believe investors should embrace.
So, Ursula, I mean, for me, I'm thinking of fixed income, so I don't know what you do there. But also, if you're outside the U.S., where do you want to be selective? What's the good entry point, for example, for some of the luxury or healthcare stocks in Europe?
Yes. So, again, I think in terms of the entry point and the horizon of the trade, luxury is a good opportunity at present when put in the context of portfolio diversification and a completion strategy towards that U.S. exceptionalism that we mentioned. Fixed income is another very interesting space. We're on record for we're on track for a record year in terms of fixed income ETPs. So there's definitely a lot happening there. Going back to the central bank divergence path, very different opportunities across the pond. So in the US, given the path ahead, belly of the curve, potentially short term, although there's more volatility there, appear interesting and in favor with investors. Europe is different. I see a lot of my clients having appetite for duration, and the discussion then, Francine, is very much against the politics backdrop we saw yesterday. No confidence vote for the German government. It's how to play a more benign approach towards duration, how to onboard it. And so here we have seen, particularly this month, OATs recording outflows. So the sentiment, the jitters around the political situation are taking a toll. Bonds have done really well, both in terms of flows. We've seen a year-to-date rally. And so moving forward, I'm hearing more desire to think about how to enter European durations in a differentiated manner. So think about BTPs or bonos, where maybe valuations aren't as attractive as they used to be, but certainly volatility is lower.
Right. Ursula, thank you so much for joining us. Ursula Marchioni there, BlackRock's Managing Director, ahead of EMEA Investment and Portfolio Solutions. Thank you. Now, coming up, BHP digging into growth with copper at the core of its future plans. The company's chief executive, Mike Henry, joins us here at the Conférence de Paris. This is Bloomberg. Welcome back, everyone. Now, soaring demand for copper and the energy transition will require some $250 billion of investments over the next decade, helping to drive further mergers in the industry. Now, that's the view of BHP Chief Executive Mike Henry, who says companies will need scale, strong balance sheets and technical capabilities if they're to emerge as winners over the coming decades. Well, I'm delighted to be joined by Mike Henry himself, joining us now. Mike, you see, I start with your quote because you're kind of like the linchpin of exactly what needs to get the job done.
Yeah.
How do you see growth in your industry, and how worried are you about global demand?
So I'll start by saying BHP is a long-term company. If you look at the long-term trajectory for metals and minerals demand, it's very positive. Growing global population, 8 billion today to 10 billion in 2050. More urbanization, so more people living in cities, which tends to be more metals and minerals intensive. Rising living standards, the energy transition, AI. All of these things require more metals and minerals, so the long-term trajectory for metals demand is quite strong, and BHP is positioned at the forefront of that to meet the world's need for critical minerals.
Mike, I mean, there's, of course, a number of some of these minerals that most people can't pronounce, lithium and then copper. Why have you gone for copper as a really thing that actually is needed more than anything else for the transition to work?
So copper demand is ubiquitous. If you think about the number of uses of copper, be it the phones that we carry around in our pockets, to televisions, air conditioners, wind turbines, electric vehicles, it's pervasive in the economy. And so we see that demand growing strongly over time. One of the other things that we love about copper is that it has a steep cost curve. So the cost of producing it from one asset can be a lot more economic than producing it from another asset. So if you've got your hands on the right assets, you can generate really healthy margins. BHP is already the world's #1 or #2 copper producer. We have the world's largest endowment of copper resources, and we have big growth prospects now in Australia, the US, Chile, and more recently in Argentina. So we're positioned quite strongly in this quantity that the world's going to need so much more of.
I mean, do you want more through M&A?
So M&A is one lever in our arsenal of potential avenues of growth. We're already very well set in terms of our existing business, existing resources, and the growth options that we have. And no M&A deal is ever a must-do for us. But where there's an opportunity for us to unlock greater shareholder value through it, it's something that we've shown ourselves as willing to consider. But again, plan A for us is develop more of the resources that we have and these fantastic growth options that we've already developed inside the company.
So what does M&A depend on? Is it price, or is it actually strategic fit, or is it political, blessing?
It has to be on strategy for BHP, so it's in the commodities that we've chosen to be in. It has to be of asset quality that is in line with the assets that we want, which are large, long life, low cost. And there has to be opportunity to unlock more value for shareholders through BHP's ownership. And so those opportunities are few and far between.
I was going to say there's just not much around that fits that criteria.
Yes, which is why we focus on making sure that the opportunities that we have inside the company are so strong, and that's really what we rely upon, is this pipeline of organic options that we've developed.
Mike, when you look at, of course, the inauguration of Donald Trump, I mean, we're expecting policies to be pretty much in place. What does that mean for China? What does that mean for your industry in general?
So it's still a bit early to tell. I think for our industry, over the long term, we expect growing demand for key commodities to continue unabated. However, in the near term or along that path, there is going to be a degree of uncertainty related to trade flows, tariffs, industrial policy, and so on, which are something that we keep a very close eye on. Specifically in respect of the incoming administration, we know that there's strong support for mining, strong understanding of the need for security of critical mineral supply chains. Exactly how that plays out in practice and policy, yet to be determined. There has been bipartisan support in the U.S. for more mining in the U.S., permitting reform, and we expect that to continue and to be a strong area of focus for the new administration.
But does that change actually the way you'll run BHP?
So BHP's strategy is one that is very long-term, focused on the global level. The U.S. isn't currently a big market for BHP. It's about 3%, 4% of our revenues. But of course, the U.S. plays a key role in determining policies that apply to the industry globally. So it's something that we stay very close to. Our strategy is one of positioning ourselves in the right commodities, large assets that we can expand over time, specific focus on copper, potash. We've got a big development underway in Canada. Iron ore, we have the world's lowest cost, best performing iron ore business, and in a subset of only the best quality coals for steel making. The other thing I would note is that BHP's production is almost exclusively from countries that have free trade agreements in place with the U.S. currently: Australia, Chile, and Canada.
What does a Trump presidency mean for the energy transition? Does it actually slow it down? And so does it mean that everything is a little bit slower, even access to these critical minerals, that you have a bit more time?
So it's a really interesting question, and I don't think this applies just to the U.S. If you look at governments around the world these days, they're facing competing pressures. I think there's a broad understanding of the need for the long-term need for the energy transition, but at the same time, policymakers are needing to deal with cost of living pressures, resurgence of industrial policy, trade protectionism, all of these factors coming to bear, and how governments then weigh up and balance between those factors in the short term, of course, is the key consideration. But I don't think it detracts from the long-term trajectory of the world achieving the energy transition. That energy transition is going to be metals and minerals intensive, which is going to compound demand for certain commodities off an already strong baseline as the world's population grows, urbanization continues to play out, and as billions of people around the world chase increased living standards akin to those that we enjoy.
What can shareholders expect in terms of dividends and buyback?
So BHP has a very clear capital allocation framework. It's something that we put in place back in 2016. We've been consistent in execution of it. So one of the things that BHP is known for is our very simple strategy and our very consistent execution against that strategy. We made great progress in recent years. Operationally, the company is performing very well. We've returned significant cash dividends to shareholders. In fact, we were the largest cash dividend payer in the world in any sector for a couple of years running. We remain one of the highest. And so this capital allocation framework that we have in place, coupled with the very clear growth prospects that we have in potash, copper, the high-performing iron ore business that we have, bode well for long-term shareholder returns.
Mike, I have a couple of things. You know, BHP has previously stated the same work, same pay laws. I mean, that means that there's like 800 million of unexpected costs that come from that. What does it mean for can you mitigate that, or what's the way forward?
So we have to continue to drive forward on productivity. In the end, productivity is everything. And it's one of the key points that we make to policymakers in Australia and elsewhere, is that what countries need to focus on is getting the fundamental policy settings in place that support global competitiveness. Now, in respect of that specific policy, we believe that it brings with it higher costs for no improvement in productivity. We're very big supporters of wage increases that are accompanied by productivity increases. In that case, that isn't, the wage increase wouldn't be accompanied by productivity improvement, so it would pull us backwards on the competitiveness front. We have to work very hard to continue to improve productivity through other means to offset that increased cost. And the costs are still a little bit, we have to see exactly how the policy gets implemented, but it will mean more costs. And we're offsetting that through our application of technology and through improving work practices through other means. And we have a proprietary system in place called the BHP Operating System, right, which is our way of working inside the company. And that's what's helped move us from not being the best performer in the industry operationally to now having the best performing iron ore business in the world, lowest cost for 5 years running now. And we'll continue our focus on that and how we go about enabling the 90,000 people who work across BHP.
The productivity puzzle is one of the most important and difficult questions that any chief executive can ask themselves. Does AI help even at BHP in this regard? So
we've been using AI now for a few years, and it is helping with everything from how we go about finding resources, how we go about extracting them, the efficiency with which we're able to mine and then process these resources and get them to market. And the exciting thing is, I don't think we yet know what the full potential of AI is. It's not the sole focus. It's at the end of the day, it's an enabler of the underlying business and the way that people work. But yes, it's already unlocking value for BHP, and there's lots more to come.
Mike, I know there's a UK governance law that basically suggests that a chair steps down after 9 years. What does that mean for your chairman?
Oh, so it's probably a question better for the chair. But one of the things that BHP is known for and has done a very good job of in the past is our approach to succession. But I know that certainly from my perspective, the company's performing well. There's still so much more opportunity ahead for BHP, and I can say that both the board and the management team are very much focused on running the great business that we have and unlocking more of that opportunity for shareholders and other stakeholders in the coming years.
Your biggest challenge for next year?
So just one
Not
challenge
one, right?
for next year. Of course, safety is always front of mind. In an industry like ours, looking after our people is priority number one. My management team and I spend a lot of time out there in the field talking to people, making sure that we understand what their challenges are and how we can go about better enabling them. Of course, there's all the uncertainty around trade measures and so on in the year ahead. It creates some near-term uncertainty, but the long-term outlook for our industry, for BHP as a company, and for the commodities that we produce is positive. And I'm focused on how we go about positioning BHP to best capitalize on those opportunities in the years ahead.
Mike, thank you so much for joining us today. That was, of course, Mike Henry, the Chief Executive of BHP. Now, coming up, we'll have plenty more, of course, on the rapid rise of weight loss drug maker Novo Nordisk. We spoke to the Chief Executive a couple of weeks ago. It's hit small businesses in Denmark because of hiring. So we'll have plenty more on that story next. And this is Bloomberg. Welcome back. In Denmark, Novo Nordisk's rapid hiring spree is making it difficult, very difficult, for small businesses to find staff, leading some to close down. Now, for more on all this, let's bring in Bloomberg's Sanne Vaz in Copenhagen. Sanne, so Novo Nordisk is the #1 driver of GDP and job growth in Denmark. Tell us more about the fight for talent in Denmark.
Yeah, so Danish economy is doing well. Employment is at record high, thanks to Novo Nordisk. And of course, that's very positive for Denmark as a whole, but it's just not all that are feeling these benefits. So for your background, Denmark is a small country. We're about 6 million people. And Novo Nordisk is on such a rapid hiring spree at the moment that it's vacuuming the labor market for everything it can get. And for businesses, especially in those areas where Novo is present and growing, that's really causing a lot of challenges, especially because Novo comes in with attractive salaries and attractive pay, and a lot of people want to go and work there. Other businesses, they struggle to recruit as well, and they're really starting to feel this pain of not being able to find the labor.
But Susanne, what are the consequences for businesses and for the Danish economy?
Well, it means that they're just not able to grow as much as they would have been if they could get the staff that they needed. So we hear of businesses that are having to decline orders. Some are delaying expansion projects because the construction companies don't have enough staff. I've also spoken to a company that decided to move production abroad because that was the only way out, as he saw it. And another company, a car repair shop, that was just a half a mile down from Novo Nordisk in Kalundborg, decided that he was just too exhausted from having to look for staff all the time. So he closed down his shop. So of course it's an issue for those businesses and their growth, but but for the Danish economy as a whole, it's really kind of sorry, am I still on?
Yes, Sanne. I mean, it's obviously one of the biggest challenges going forward. Sanne, thank you so much. I urge everyone to go on our website and read Sanne's story from Copenhagen. Plenty more to come from the Conférence de Paris. We speak with the L'Oréal Chief Executive. This is Bloomberg.